Hello, everyone. Wobbly Giraffe here with another video. I am on the road, as you can tell by the room behind me. I'm traveling to meet up with some friends in Georgia. A little tired. Drove for most of the past 2 days, more or less. So there is that. However, I wanted to go ahead and make a video giving some updates. Okay. So I'm going to share my screen and we'll go through some more articles, kind of linking, what was his name? Glenn C, I believe. Glenn Chan to Chris Ritchie and some of what they've said that's in common. And the end goal of this video is to talk about how Glenn and a lot of other research papers, once again, I think he breaks it down the best, say how to value miners versus how Chris Ritchie is talking about this stuff in the context of Silvercrest miners and why I think they're both correct and how we can look at what Glenn is saying, how he's looking at a specific mine, and Richie's talking about the overall business, which has multiple mines. Okay. So I'm going to go ahead and share my screen. Am I already sharing my screen? I don't know. Oh, somehow I'm sharing eBay, I guess. Where are you? What did I do? 1 second, everyone. Okay, so I guess I'm sharing my screen, which is the laptop. So hopefully now it's the article. We'll see. All right. So let's see, I didn't exactly organize how to do this, so let's just start swinging, right? Let's just go right through it. So Glenn had an interesting basic level article about issues with mining stock. It's believing in management. A lot of his articles are about management of the certain mining companies being unethical, I guess is the way to put it. Probably dancing that line of legality. And that's something he talks about in a lot of articles that we covered a little bit. Institutional investors don't know how to do their due diligence. Sure. I find it's also the data is somewhat hidden, which I know Glenn has covered quite a bit. So we'll dig into that. We'll find the truth in that regard. Um, Pervasive incentives. It seems like there's this constant merging of companies or splitting off. There's share dilution. There's ways that they're kind of hiding whether their company is good or not and whether they are generating economic value. Okay. Um, we can see here that the company's more or less just trying to pump their stock shares versus generating value, which is not feasible in the long term. Maybe in the short term it is, and there's other ways we can kind of keep short terming it, but in the long run, that's not good at all. Okay, so there's the lack, which kind of builds into point four. There's the lack of value creation, and I'll say right off the bat, this goes to my last video, which once again, I kind of apologize for the audio from the video not playing through the thing. I uploaded and I realized, yeah, it's a lot of me staring at a blank screen. So maybe I'll try and figure that out. Upload another video with them talking. I tried to pause and give my thoughts on what they were saying after saying what they're saying. Please check out that video. I do think it's worth 26 minutes of your time. So there's that. Regardless, this ties in very closely with that video. The most important graph in that video that Chris Ritchie talked about was the metric by Crescat Capital LLC, which was pushed by Bloomberg, I would assume either in their news or their terminal, that was talking about how a lot of miners are not value creators. They are value destroyers. They are capital destroyers, right? And the metric they gave was the 12-month trailing median free cash flow over the enterprise value. Okay. Not necessarily a simple formula, not necessarily complex. We will break that down conceptually later in this video. Okay. But that was the metric that Crescat and Chris Ritchie believed were good indicators of the mining sector or specific mining companies in the sector overall and whether they were contributing back to the economy, right? So if they're digging a bunch of silver, or gold, I mean, in our case, silver, they could look profitable on paper through share dilution, mergers, acquisitions, these sort of tricks that Glenn has talked about, and a lot of other people have talked about. To Chris Ritchie, a way, and Crescat, and Bloomberg, I guess, promoting that article, or people that read that, figured it was good due diligence. A way to tell whether someone is a capital destroyer or a capital producer is that metric, the 12-month trailing free cash flow over an enterprise value. Fair enough. So we'll have to discuss that conceptually and whether I agree or disagree with that. Now that does tie in somewhat to what Glenn said about looking at the discounted cash flow of each mine. Okay. Now that, to me, and we'll talk about this a little bit more down the road, that could get very hard to do, right? If it was one mine, wouldn't be too bad. I mean, some companies don't even release the best information on doing that for a single one of their mines, which is a red flag, according to me and Glenn. But to do that for like 4 or 5 mines, or even 2 or 3, becomes tedious. And if we think about the mining company's whole portfolio being mines, I mean, none of them are like multi-sector. They're all generally in the mining business by itself. Well, their accounting books then become this snapshot of their mines, right? Obviously. So we want to look at some of the metrics in their financial sheets, maybe 1 or 2 of their mines in the context of what Glenn is saying, or maybe just their big producer, right? Their biggest mine. Because I know some companies, they have one huge mine and then a couple small ones, right? In that case, probably the big mine is the go-to there. But we want to evaluate the best way of valuing. It's kind of a funny tongue twister, but we're trying to evaluate the best way of valuing these mining companies. And I think it's some blend of what Glenn is saying of using discounted cash flow on their mines. And I think it's something what Crescat, this article published by Bloomberg, or mainly Crescat, I guess. I suppose Bloomberg found value in it. And kind of what Chris Ritchie's talking about of looking at the 12-month trailing median cash flow over enterprise value. Okay. And this is all to determine, are they creating value? And I will reiterate, Glenn said, and I agree with this, a lot of people say this, that price to earnings doesn't matter, because a lot of these miners are pumping their stock value. Price to book doesn't matter. Once again, that's just kind of the sentiment in the market on their stock, rather than is it creating value. And some of these other metrics, there's EBITDA, quite a few others that may not be giving us the best sense of how these mining companies are doing when accounting for the economics of the sector. Okay. So let's see, what is he talking about here? Trying to mine investors, pay for shills, fancy investor trips, conferences, corporate videos, investor relations expenses, trying to constantly, pump their stock value. I find that mine investors, that's a good meme, a good whatever. Do they own hundreds of stocks? If so, they probably don't know what they're doing. Mining assets are incredibly difficult to analyze. And that has been somewhat what I have found. Do they value a mining asset by taking the amount of resources and dividing it by the market cap? This is a ridiculous valuation method. Now, once again, I did kind of do that in my last video. I'm not sure if I recorded that or not. It just was to get a gauge of whether the stock is undervalued compared to the amount of silver in the mine, and minus the cost to mine it and the efficiency. Now, here he didn't talk about taking out the cost. I did try to expand that equation to be more revenue versus, yeah, they have X amount of silver, here's their market cap, they're undervalued. Because we do want to account for the cost of mining, their capital expenditures, and similar, how much they're gonna have to pay to get the material out, get it to the market, et cetera, et cetera. So I mean, yeah, that's true. That is a very crude way of doing it, but as silver dwindles somewhat and most of the mines run out or silver gets hard to find because it's a precious metal, we do kind of come down to who owns the most silver. But we do want to take in the cost to mine, um, the capital expenditures, or just the amount of fixed costs, operating costs, et cetera, in that context. Okay. So yeah, it is ridiculous, but we can just at least take the size of the mines, costs, everything else, and try to determine some value. And that's what we're trying to boil this down to. What formula best gives us the excuse me, not the cost, but the value added by that mine. Okay. Okay. Let's see. So here was another article by Glenn. Once again, a lot of research by professors, but it wasn't necessarily easily digestible. Which is I'm trying to make these videos to make stuff more digestible, versus reading a PDF by Dr. So and so, where it's like is this even this is barely understandable. So what he talks about, once again reiterating, is the discounted cash flow model. It's where we're taking the mine, the amount of silver, the price of silver minus the cost and what have you, over the life of the mine. Typically, we'll see the cash flow is negative in the early years because we're spending money to set up the mine, build the mine, what have you, and then over time it will become positive as we're mining the silver. However, it then will fall off toward the end of the mine's life as we're running out of silver to mine, and we're going to need to set up another mine. Okay. Okay, so the discounted cash flow model gives us the net present value figure. Okay. I'm actually going to take some. Do I still have that pen? Well, I'll come back to this, but we do want to get that net present value figure. Sure enough, per mine. There is the garbage in, garbage out issue. A lot of the mining companies have legal but kind of sketchy ways of making the mine look better than it is. Okay. So we have the size of the deposit, the geometry of the deposit, which probably means do they have to spend more or less money to get that silver out? I mean, if it's kind of all clumped together, it's one big rock, then probably would cost less than if it's, splintering out all over the place and is smaller deposits. Okay, so that's fair enough. The distribution of grades, erratic distributions of the mineral adds uncertainty to the overall estimate. Gold and diamond deposits tend to have erratic distributions. So you could go mining in this way, find a lot of it, and then around it, you find very little. You go mining this way, you find a lot of it, and then there's like nothing around it, right? Notice he didn't say silver has an erratic distribution. So that's good. Social and political factors. It's something I will touch on. I do know one of the mining companies was in Peru where the president's like, yeah, I'm going to tax this 70%, or he was even talking about not letting them mine. So, that pretty much destroys that company right there. Let's see. Infrastructure, metallurgy, how efficient are they in getting the silver, dealing with sulfur, those other things? Sure. Mine operations, sure. Human behavior, I mean, are they treating their workers right? Do they have a lot of accidents in the mines, whatever? All right, so we do have to account for commodity prices. I mean, silver is already double what a couple of mining companies kind of use to forecast stuff on their accounting books. Do they have fixed cost or variable costs? Very true. Did they buy the mine for a lot? Due diligence. Let's see. Oh, another article. I'll check that out. Okay. We don't typically want to believe their technical reports. Okay, fair enough. Do they believe in the project? That might be kind of hard to determine. But hey, we'll check that out. Okay, so let me decide whether I want to. We could talk about this a little bit, so let's do this. Mining exploration has been a disaster since 2020. Now, this was in 2018. So something to look out is for what companies merged before, well, 2018, 2019 to stay in business, pump up that stock. What companies are still around. This was something Chris Ritchie talked about, that a lot of the big players that do the mining might have the capital, but they're not willing to take that risk. So someone else has come along, found the mine, sold it off to them. Well, the issue with that is their projections are generally going to be like lower. They would rather get a medium grade mine and it be a safe investment. So they have a pretty good picture of how much stuff is in it or how many ounces of gold, silver, whatever they're mining for. But they're not going to get those high grade, high yield mines, right? So, but exploration has been a disaster. So that means that a lot of players probably aren't necessarily doing as well as they would like to pretend they are. Okay. So we had a failure in 2005 of a mine found in 1996. Those turned it, or that turned into a profitable. Okay, fair enough. And then there's the diamond mines in 1998. Here's an interesting sense. I suspect that. Oh, can I? I suspect that Voisey Bay accounts for almost all of the industry's value creation in its pre 2000 cohort, and that's kind of what I'm looking for. Is I believe a lot of these mining companies are way overvalued and are value destroyers. So even if the price of silver goes up a little bit, they still have a lot of debt to cover. They still have high accounting costs and whatnot that make them worse off than other miners. Okay. And no matter how high like silver were to go, that doesn't change their high costs of doing business, their share dilution, and these other things. So there's outsized gains to be had during this silver boom for the miners that are value creators, not destroyers. And even right here, I think Glenn does a lot of good work. I've read a lot of his other articles and I'm continuing to find more good ones. He's saying he believes that this one company's mine, now they are in the diamond field, sure, accounts for all of the value creation in the pre 2000 cohort. That kind of blows my mind because it's how many miners were in this sector, 10, 20, 50, 100. Even if there was only like five, that means all of those other companies were essentially taking good value from investors, in this case, dollars, but value in terms of other stuff. Maybe those investors gave up some stuff, food, and we're like, oh, I really like this company, and boop, that's out the door, right? So they're value destroyers, and we kind of use dollar bills as the proxy for that, or just dollars, or whatever they're trading in. Could be another company, another country stock as well. So, what happened? They're value destroyers. Okay, so this stock was run by a serial stock promoter, environmental villain, and convicted criminal. He went to jail over LSD trafficking. Oh boy. The exploration plan was arguably dubious. They're looking for diamonds in a region not known to have any known to not have any diamond mines. That's hilarious. Still, there are no diamond mines in the region. Nonetheless, they got lucky and stumbled across a multi-billion-dollar nickel deposit. If that isn't a good story, I don't know what is. So I guess they were looking for diamonds and they found nickel. God, that's hilarious. To have made money in junior mining, you would have needed to invest in a company with bad management and a bad exploration plan. So what does that mean if we have a company that has good management and a good exploration plan? Well, one, they might just fail. Unfortunately, that's kind of what this implies, the opposite of the story. However, I think certain businesses, in the case I like Silvercrest Metals, it's they sold a mine very close by and said, okay, we're pretty sure there's more silver over here. They're very carefully exploring. They just bought a second, maybe a third property, and they're just expanding and they're keeping their costs low, right? So I do think they have good management. They have a good exploration plan. That being said, we want to double check and triple check our due diligence to make sure they're a good company. You know, they could just not luck out. However, I absolutely do think they are doing a great job and have that value creation phase ahead of them, where a lot of other companies cook in the books somewhat. And so you might have bad management, you might have a good exploration plan, but they're not going to stand the test of time, right? All right, so here's some mine discoveries after 2000. He doesn't know about that Australian miner, Rista, Bloom, blah, 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 blah. This post 2000 cohort has very little to show despite all the money spent on high risk greenfield mineral exploration. Fair enough. Its economics fell short of its projected numbers, projected 24.18 per ton cash counts, actual cost in the ballpark of 85 to 95. Wow, that's almost what? I mean, that's more than triple. That's not good. When the surge in ore prices ended, they shut down after only 5 years of operations. Yeah. And what I would add, maybe, and I don't know if this is the case here, but did they just end up selling that property to another miner who was like, okay, well, we know there's iron here, we're going to go ahead and mine it? Does that then mean that that follow-on miner, right? Excuse me, a little itchy my beard. Does that mean that that follow-on miner, like, they might not necessarily be in good shape either? Because yeah, we knew iron was there. How much was it? What grade was it? You know, they could make a profit from that, but the mine's already 5 years into its mine life. You know, maybe it took 1 or 2 years. I almost said 1 or 2 months, 1 or 2 years to set up. And there was only 3 years of mining. So like maybe the best days of the mine aren't behind it, but that kind of becomes a tricky situation in of itself, to forecast for that company that might have bought that mine after they closed down. Hard to say. So how he would handle mineral exploration, I would look for extensions of existing high margin deposits, keep following deposit and see how far it goes. The exploration strategy is extremely obvious. It's clearly high risk and or high reward and low risk. Sure. There's no economic force that will punish you for doing something that's obviously a good idea. So I would assume what he's saying is they already found a deposit of something, Silvercrest has, and now they're either expanding that or they're making pretty safe bets on opening new mines for a low cost. Okay, and they're increasing their efficiency, they're lowering costs, or they have fixed costs versus variable costs. Or similar, right? Okay, cool. So here's kind of a new interesting one. Now, remember, this was written 2 years ago, so maybe not current companies, but they own high margin deposits, and they might not be in silver, which once again, I think will have a huge bull run, but they own high margin deposits. Okay, they have accounted for most of the world's new supply for the minerals that they produce. If you look at iron ore, which I'm not interested in, but still a good example, the existing tier 1 mines have accounted for far more new production than Bloom Lake, which is currently closed because it's uneconomic. Arguably, high margin mines have been the best exploration plays, right? So the company that owns that existing tier 1 mine is essentially probably the best bet for finding new mines, exploring them, and making them economical, not wasting money through share dilution or just high costs, etc., to get that mine going. However, it's unclear to me as to whether or not the stocks are good investments. Mining CEOs have a tendency to pursue crazy expansions, such as Cliffs losing billions on Bloom Lake, Vale building supermax ships that can't dock in Chinese ports, and BHP's Jansen project. Doing nothing while it doesn't impress clueless institutional shareholders is very often very better than doing something. Yeah. Building very expensive ships that can't take the ore to another country does not bode well for a company. Okay. So why bother with single companies? Sure. I think if you pick that one diamond in the rough, or in our case, the one silver bar in the rough, or what have you, I don't know how to mean that one, but the one diamond in the rough, sure, right? Diamond hands. If you were too scared to make that choice, well, yeah, the obvious move would be go with an ETF. But I think there's heavily skewed outside gains if that one company is found. I'm willing to run that due diligence and that risk investing in that company myself, because even as this article admits, a lot of miners in that sector are not economically feasible. So if you were to invest in an ETF, in this case, he's pointing out gold, right? GLD. It has outperformed the gold miners. It's because you're looking at the commodity versus the miners, because most of the miners are uneconomical, right? So you're betting on the gold as it already exists on the market versus the miners. And I think there's a couple of reasons that this is going to change somewhat, right? GLD probably run by iShares, might have the custodian of JP Morgan. I could be wrong. But I know SLV, the custodian, was JP Morgan, and they were manipulating the price. So it's like, even if you had outsized gains on SLV, they were all paper gains or paper losses, right? That era is coming to an end because people have caught JP Morgan's bluff. And now we're looking at physical silver, we're looking at PSLV, and we're looking at, in my case, once those two run out and can't, I was putting those two fingers down. I didn't mean to have just my middle finger up. Sorry for that. Let's do that. My bad. What was I saying? If once physical silver runs out, right? What does that leave? That leaves the COMEX, which PSLV has access to that. Or there's ways you could take physical delivery, but those end up being pretty messy, right? So we have physical silver, which there's going to be shortages soon. There already are shortages. There's PSLV, or taking physical delivery in more difficult ways from the COMEX. Well, they're running out. And there's the third, there's the miners, right? So I'm trying to get ahead of the curve because those two are definitely going to happen. And then we're looking for the miner. Well, the issue with the miners is, are those stocks manipulated? Could be, right? I know quite a few of them have a decent amount shorted. We don't know how the dark pools exist for these shares, and maybe there's a lot of hidden manipulation behind the scenes. Okay, could be possible, probable. Not sure. I've seen stuff like that. But we're also looking for that one share in the rough, or the couple of shares that are economic value generators, because the rest of these mines could either be cooking their books somewhat, maybe legally, but they're trying to hide that they are a failing business. They might engage in shareholder dilution. They might essentially do things to pump the stock price, but they don't have a good underlying business. Maybe they're at the end of their mine lives. And so it's like they're running out of silver. And so they can't take advantage of the silver bull run, because they're going to have to spend years and years and years setting up a new mine. And we don't even know if that mine's going to be good or not, right? So we want some indicators of what mining companies, in my case, in the silver industry, are not only economically viable, have good management, and are generators of value for their shareholders, but are positioned to take advantage of this bull run. And this ties back into what we've talked about with these articles, some of the PhD papers, that video with Chris Ritchie, and some of their other videos are a good watch as well. So I think that kind of covers that topic pretty well. So what does that leave, right? We talked about how Glenn looks at the discounted cash flow or the net present value of these silver mines, or he looks at mining companies. I'm looking at silver mines, I guess. Okay, so let's kind of cover what these are from a basic standpoint so people can understand that a little better. And this is used for a lot of different companies. So maybe, down the road, you can look at this for other companies as well. This is the educational component of the video. Okay, so Investopedia has just kind of some good basic articles on this stuff. They have different valuation fundamental techniques, the basics, some of the ratios, looking at statements. So it's not a bad website by any means. I think it just kind of covers the basics, but it gives good explanations of those basics. So let's go over those. So Glenn Seat and a lot of PhD papers from financial professors talk about looking at the discounted cash flow of mines. Okay, fair enough. So what is discounted cash flow? It is a valuation method used to estimate the value of an investment based on its expected cash flows. Okay, so we're trying to arrive at a number that tells us at this point in time today, okay, is this investment, in this case, it is the mining company, i.e., its mines, a good investment. Okay, so we're trying to arrive at, is this mine generating value today, but also is it expected to generate value until its mine life is over, right? That more than makes up for today if it's negative. We want positive value generation, essentially. Okay, so it attempts to figure out the value of the investment today based on the projections of how much money it will generate in the future, right? So if we're looking at a mine, it's how much, let's assume they have a new mine, they're just starting out, right? It's how much is it costing to set up the mine, which gives us negative for a couple of years, right? How long is that mine going to take to set up? Is it super negative for 5 years, right? Versus 2 years, 1 year, 6 months, what have you. Okay. Then it's how many resources are in the mine that they mine, say, each year, minus the cost of accounting that stuff, right? Plus any other costs, fixed costs, variable cost, how much to set up a plant, that sort of thing, right? For the mine, the life of that mine, let's say it's 10 years, right? So 2 years, super negative. Maybe for the other 8 years, it's super positive. That does make up for those 2 years and gives us that positive number today. Okay. We also need to account for, is it positive enough to then buy another mine and continue the process with that, right? Let's say it was relatively negative for a couple of years. So you're like, oh, okay, their cost to set this mine isn't high at all. But then it's like their positive years of mining are very low. Maybe they find less silver or they have high cost to mine. And it's like, okay, maybe they had a positive net present value, right? Which might give them a positive cash flow slightly, but they then don't have enough money to continue that exploration process, or they pay someone that essentially already explored something and it's a decent mine. So they're kind of stuck in that rut of they just keep getting decent mines and they're not really generating value, maybe a little bit, but not a lot. I know the articles and the research suggest that most players in the field are not generating positive value, right? So we're looking for that diamond in the rough. That means they have to explore, most likely. They have to be willing to take those risks in a smart way. Okay, so they can have negative cash flow for a couple of years, but if they find a great mine that has high high silver amounts, but it has high cash flow through mining, minus the company has a low cost to mine and process, transport, et cetera, et cetera. So they could be very negative in the first couple of years, but they're negative. They're setting up the mine, obviously. Then they have super high cash flow for the life of the mine, and they're looking to continue that process in other mines. That's what we want, right? That would be a very good net present value. Okay. So how it works, the purpose of DCF analysis is to estimate the money an investment would receive from an investment adjusted for the time value of money. Okay. It assumes that $1 today is worth more than $1 tomorrow because it can be invested. right? Fair enough. Uh, let's see, it finds the present value of expected future cash flows using a discount rate, right? So here's kind of the formula, and we can apply this essentially to the mine life, right? So it's the cash flow of the mine in year one, year two, and all the way to the end of the mine life, essentially, discounted by 1 over the discount rate. Okay, so a lot of people kind of use treasury bills in this case. You could argue it could be the rate of financing they need to do the mine, right? So if they have a 10% loan, well, per year, they better be making more than 10% per year to have that positive cash flow, right? Their debts versus what they're making per year. We could argue that, right? I mean, inflation is going to go sky high. I don't think that necessarily plays into this equation directly, but financing is going to get harder to get if the economy turns south, right? So inflation is going super high. Liquidity is probably going to drop up. So, you know, what happens down here when they can't get a loan at a good rate? You know, rates are zero right now. They're only going to go up, and they're going to go up a lot when they do. So it's like, what happens down here if their cash flow is positive for these 0% rates, but then interest rates go to 5, 10, 15%, meaning corporate rates go up? It's like game over down here, right? So I guess that's kind of how the economy turning south plays in, like down the road a little bit, right? Okay, so here they're kind of calculating a specific number, and it's let's kind of they use the weighted average cost of capital as the discount rate. Sure, we could determine that for companies. That seems like a fair enough one. But let's kind of take the full example, right? So what they're doing is this company is getting 1 year of cash flow in year one and two, 4 and three, 4 and five, and 6 million and six, right? We could argue this is a mining company's mine as an example. So here they would have a 5-year mine life. They would have cash flow from the mine of 1 million the first year, 1 million the second year. So maybe they're building out that mine, but they're mining stuff on top of the mine. Maybe there's some silver deposits on the top of the ground. So they're getting that positive cash flow even while they're setting up the mine. Well, maybe they finish building the mine. They're really starting to mine in year three. So they get 4 million. Year four is 4 million. And year five, which we could argue is the final year of the mine. And in this example, at least they get the most, they get 6 million. So maybe they found silver deep in the mine, right? That's a good example there. So we discount that mine to the present period, right? So maybe they just bought the mine. This is what's projected, right? We discount that by the weighted average cost of capital, or essentially how much they are spending to set up the mine and their projected accounting costs to today. So we have less than 1 million because obviously they're taking a loan, less than 1 million because they're taking a loan, right? Less than 4 million because they're expending costs to get that silver, 3 million more cost, obviously, in 4, right? So that means that if we had all of the money today, we're giving up some of that money. That's the present net present value and the time cost of capital. We're giving up some of the money to make this investment that we could be using somewhere else, right? They're using some of that money to essentially set up the business and mine and whatnot. In the long run, we hope that we get more money back by making this investment, right? So, okay, so in total, we get that 13 million if we sum these, okay? If we subtract that initial investment of 11 million, we get a net present value of 2.3 million, right? So it is essentially, if the projections turn out to be true, right? We're not getting overhyped numbers and these other things, then yeah, that's an economically viable mine. Now, is it as economically viable as other mines? Well, we don't know, right? If most mines are negative, then absolutely. Are we being told the truth? Are the numbers being somewhat cooked? There's a lot of other things that kind of go into this, right? So because this is a positive number, the cost of the investment today is worth it because the project will generate positive discounted cash flows above the initial cost, right? So if it was negative, we don't want to invest in that mine. That's kind of the telltale of whether it is a economically viable mine or not, okay? If the project had a cost of 14 million, so whether it was a initial fixed or variable investment in the mine, whether they paid more for the mine or maybe they cost more to mine. Well, I guess cost more to mine would be in each period versus the initial cost, but that would also lower these, I suppose. Let's come. Oh, I somehow just duplicated the tab. Oh well. What did I do? Sorry. Okay, so we want it to be positive. We want it to be very positive versus zero or negative. Okay, so what are the disadvantages? It does require some assumptions. We want to be able to correctly estimate the future cash flows, which that's hard with a mine because they could have more rosy feasibility studies or projections than they are actually looking at. So there's a lot of assumptions that the truth is being told to us in that case. Market demand, status of the economy. What if interest rates go very high? Technology, competition, and unforeseen threats or opportunities, right? If a country shuts down mining, which looks like that could happen in Peru, I believe it was. So there you go. There are a lot of assumptions with this model. That is very important to know. So let's look at this. How are cash flow and free cash flow different? Okay. So Glenn said to look at the discounted cash flow of a mine for its present value, right? Because mining is in the future. Okay. The issue kind of with that, not that it's wrong, that becomes very tedious and hard to do for, let's say, a company that has 5 mines that are at different stages of their mines. It's doable, but we also would have to assume that they're telling us the truth, that their numbers are not necessarily being cooked through share dilution and some other things, right? Oh, sorry, I just saw something fly by the window. That their accounting books are accurately painting the picture that we want to see. So price to book is already out of the framework. There were some EBITDA metrics that are out. There was price to earnings because none of those are reflecting the economies of a mine or a mining company that has multiple mines, right? So Glenn's metric is discounted cash flow. Fair enough. Seems good to me. Makes sense. The issue with that is we have multiple mines at different stages. That becomes very kind of clunky and could be used to kind of hide shareholder dilution, I would argue, or paint a rosier picture, right? We could have a very economically viable mine, but we have 4 highly uneconomical economical mines that are destroying value and destroying more than that mine is producing. But like, what if they're in their early stages and that one's in its late stages? So we're almost done with our highly profitable, highly economical mine, right? That makes our company look good. But after that's done, we have 4, 5, 6, it doesn't matter. Let's 4, right? Just keep it simple. We have 4 very uneconomical, value destroying mines that are our investments. It's like, oh, to next year, this mine's over. We start digging in all of these. Well, our company just went from a value creator to a super capital destroyer. And like, what are we going to do if management knew that or something? Oh, shareholder dilution. Like, we'll bring the stock price down while we're ahead, which wrecks the current investors somewhat, right? They lose a bunch of money, and then paint a rosier picture out here, and like maybe they drive the price of the stock down enough that like it's below what these mines will produce for us. So it's like, yeah, the share price goes back up until those mines are over. Well, still a bad company, right? So it's a mess. In short, I guess it's a mess. Okay, so we have cash flow. Cash flow is the net amount of cash and cash equivalents being transferred into and out of the company, right? So they're mining silver, they process it, they sell it, they get cash, right? That's cash flow. Positive cash flow indicates that a company's liquid assets are increasing, enabling it to settle debts, reinvest it in its business, return money to shareholders and value, right? Shareholder value, and pay expenses. It is reported on the cash flow statement, which contains 3 sections detailing activities. Three sections are cash flow from operating activities, investing activities, and financing activities. Well, this is actually, I wish I had my pen so I could take notes because this gives me ideas as I'm reading through this. But operating activities would be mining, right? Investing activities could be shareholder dilution, I would assume. Maybe that might go in financing. I mean, if we're issuing more shares, that'd probably be investing. Investing might refer to them in other companies. So it'd probably go in financing. But we could have like negative cash flow from operating and then like positive from these two. And that could still be a uneconomical business from mining, right? So there's that. Free cash flow, which is what Chris Ritchie and some other Crescat talked about, right? But discounting, looking at the trailing one and discounting for enterprise value. Free cash flow is the cash a company produces through its operations after subtracting any outlays of cash for investment in fixed assets like property, plant, and equipment. Fair enough. In other words, free cash flow, or FCF, is the cash left over after a company has paid its operating expenses and capital expenditures, so CapEx. Okay. Free cash flow shows a company's ability to generate cash above its operating and investment needs. Okay, so that's a great indicator right there. Free cash flow is used to measure whether a company has enough cash after funding operations and capital expenditures to pay its creditors and equity investors through debt repayments, dividends, and share buybacks. To calculate free cash flow, we would subtract capital expenditures from cash flow from operations. Okay. I do think that's a relatively easy number to find, but we can certainly calculate that, and that would come from the cash flow statement, right? So what's kind of the difference here is cash flow is that number per year. So if we have just one mine and we're in the 5th year and it makes us $11 million, it's then mining, subtracting our costs and whatnot to get, let's say, 3 million. That is just our cash flow for that year. Discounted cash flow would be trying to account for all of the years of the mine. So discounted's probably better, but what happens if we're in the 1st year of the mine? We have the cash flow of that year in that mine, right? Which I think I said like 10 seconds ago. Let's say it was 11 million, our cost of 3 million. So we have our cash flow in that year of, what is that, 9 million? No, 8 million. 8 million. I'm sorry, 8 million, right? We then would discount the future life of the mine to that year as well. So we would have the current cash flow of the mine. The discounted would be the future years as well. And our free cash flow would essentially be, we could argue, the current year minus the cost. And then we're subtracting some other numbers to get a more clear picture. So the debts and the other stuff, right? So we're subtracting some of the accounting numbers to get the cash flow of the current year, okay? Minus the cost and other things, CapEx, gives us our free cash flow. We still would want to account for the rest of the years of the mine. But, right, let's say the free cash flow was like negative and we're in the late years of the mine, then like, yeah, those last years are not going to play off well, okay? And I think the metric that Crescat published, and I think that Chris Ritchie referred to, it's taking this free cash flow. It's taking the median 12-month free cash flow, right? So over probably a couple of years, I would assume, right? But it's looking at the trailing 12-month per period. That gives us a metric across the life of the mine. Let's say we did it for 5 years. We could have a metric of how many mines were generating more than their cost. So we have a period of time that's long enough to look across multiple mines. One could argue, let's say it's 5-month trailing, or 5 years of the 12-month trailing median cash flow. Say that 5 times fast. That's a tongue twister. Okay. We would want to hopefully see that's positive and increasing. If it was negative, we would want to know why. Maybe they had to switch to a new mine and they weren't good at transitioning to a new mine. So they had to drive up costs, right? To buy a new mine, set up the plants, et cetera, et cetera. So it could go negative. Doesn't necessarily mean it's a bad investment, but we would want it to be positive, increasing over an extended period of time, right? Whew, that's a tongue twister. What did I say? Compare free cash flow across a 12 median trailing period, whatever, big term, screw it. Okay. That formula, going back for a second, that formula that Chris Ritchie and Crescat talked about was the enterprise value. and enterprise value gives us the essentially a overall picture of the health of the company, including the cost. So if we had that 12-month trailing free cash flow over the enterprise value, and that was like negative every period, it's like they could have a good mine, but they have high cost and they're at the end of the life of the mine, and they have 3 more mines lined up that are projected to be like good but not great, and they're already running low on cash, right? That metric can somewhat account for our future projections of the company. Okay, so there's that, right? I think that's a very good metric for gauging the life of a mining company. Okay, now we would want to somehow discount their future cash flows, but I think that comes down somewhat to what are their costs to mine, how big are their mine, how big is the mine, are they telling the truth of the size of the mine, the grade, whatnot, and I was kind of missing something there, but you get what I'm saying, right? Is the picture of the future years of the mine good? Is it being overhyped, or is it bad, right? Just flat out bad. Okay. So, uh, so I think free cash flow can be used kind of in a stand-in for the current year's discounted cash flow. We would want to sort of discount the future, right, of these companies. And if we can get the 12-month trailing median cash, 12-month trailing median free cash flow for a company for say 5-10 years, if they've been around that long, because a lot of these companies kind of go under, do mergers, acquisitions, and whatnot. We can have a very good picture when we discount that to the enterprise value, which includes costs, how healthy they are, and whatnot. Okay, so I think that's a very good metric to calculate. Comparing cash flow to free cash flow. Enron, Exxon. Was that the company that had the huge issues? And I'm thinking of Enron. That's Exxon. So this is an oil producer. They have cash flow. Okay. Of what is that? Oh, here's cash flow. Wait, where's cash flow? Where are you? There you go. Cash and cash equivalents at end of period. Is that billion or million? Yeah, I assume it's million or billion. 4.1 billion in cash flow for the quarter. Okay, the total cash flow includes the nets of the debits and credits. Okay, so debits, you got some minus stuff used here in their investing activities. That is going to be a negative. They're summing a bunch of that stuff up, right? Coolio, they had 8.5 in operating cash flow. So right here, they were selling a bunch of gas and whatnot. Net income, including non-controlling interest. Okay, depreciation and depletion. Okay, so they're paying off machinery that probably is being used longer than expected. Okay, changes in operation working capital, including cash and debt. So that actually is not a lot, right? And that's probably a good thing, because what if they had to take out a lot more capital or what have you? I mean, you would want that to be positive, but what if it was heavily negative, right? This could still be positive, and it's a bit of a warning flag if it was. Okay, so what else do we have going on here? Cash flow from investing activities, additions to property, plant and equipment. So they bought a bunch of maybe oil area, whether that's in the ocean or on land or whatever they do. They set up some drills and whatnot. So this isn't necessarily a bad thing. They're investing in the company, but you wouldn't want this to necessarily be like a huge chunk, unless they were very risky. But you wouldn't want this to necessarily be a huge chunk of their positive stuff, right? But they are investing in the company, so that's good. I mean, if this was negative and I don't know, they're like selling their plants, I mean, that's an extreme example, but you get what I'm saying. So all in all, it adds up to they have free cash flow of the 5.17 billion, the 8.5 minus the 3 whatever. Okay, so that's good. Takeaways: we can gain a better understanding of where the cash is coming from, right? Shareholder dilution, are they selling more shares and their business is rocky, on how the company's spending its cash. What if they have a lot of cash? That might be a good sign. But the company has taken on a sizable amount of debt, sure enough, that it can't service. That's fair enough. All right, so I think that's all good. I think that overall goes over some stuff. This was some data Glenn was talking about, a terminal. Maybe I'll use that so I can get the numbers more easily instead of having to calculate it myself. Excesses in the REIT department, that was this year. Yeah, so I mean, housing prices are going super high. I'm gonna probably read that for myself. If a junior miner finds something other than its financial or flagship deposit, watch out. Yeah, so build an uneconomical mine. Merge with another company. Don't build the mines that are wasting money. Yeah, so I mean the number 2 years, but that doesn't paste a rosy picture. That was kind of short article, but fair enough. How to bury material information if you're a junior miner. All right, this isn't super long. Okay, let's go over this. Buried in the middle of a press release about something else. Reveal material information in a quarterly, not annual MD&A because more people don't read them. Simply choose not to release it. Probably illegal and may be considered illegal if lawyers sue company insiders. They have done this. They have some insurance against this. NI 43-101 has reduced some of these abuses as companies now have to reveal more technical data about their properties. Fair enough. They often contain information about metallurgical problems with a deposit. They will very rarely mention it elsewhere. So the technical reports themselves are important. Okay, I'll read that. The N1, once again, don't have a pen. Announced delays to releasing the information. Oh, we're pushing it off. Lame excuses for why a feasibility study isn't ready or why the scope has changed until everyone hopefully forgets about it. Also, make sure that negative information is released after a private placement. Yeah, so hey, we sold 2 million more shares. They believe in our company. Next week, oh, our mine is looking kind of bad. Yeah, like that's. Hopefully, I'm not too loud that I'm disturbing the person next door. Screw it. I'm like, oh, he's watching a football game. Whoa! All right. Anyhow, make sure that negative information is released after private placement. Sure, private placement investors are supposed to be sophisticated in a courtroom, so you can argue that it's their fault they didn't do their due diligence. Fair enough. Instead of announcing that your deposit is worthless in a material change report or press release, just quietly write the property down to 0 in your quarterly or annual filing. Yeah, once again, legal, but definitely shady. If you blow up enough shareholder capital, eventually you won't have any more capital to give you. So he doesn't say this, but it's like you merge with someone else. You know, maybe they can make your mines profitable, but like, yikes, right? So learn from all these part-time CEOs on the TSX Venture Exchange. One of their promotions blow up. They still have a few others that will pay them 6-figure salaries. It's not like shareholders it's not like degenerate it's not like shareholders crossed out degenerate gamblers smart enough to figure out that every unnecessary company comes with 6 figures worth of unnecessary listing fees, transfer fees, legal fees, audit fees, and director salaries. The part-time CEOs understand that they're in the business of mining. The stonk markets. Yeah, I love how he made that kind of a meme. So yeah, fair enough. Once again, another great article. Thought I'd throw it in there. I have some more reading of his to do because I'm a fan of his articles. So that covers most of this video. I'm very happy with it. Sorry, I'm a little tired. The lighting's bad. I'm on the road, and I mean, I have not eaten real food in a while. I'm going to pick some up from the store in a little bit. So, whatever. To recap really quickly before I upload this, I reiterated how I liked Glenn and some of these professors' articles on using discounted cash flow to model a mining company. I then went into free cash flow and why I like Chris Cat and kind of Chris Ritchie talking about that in that great video. Once again, highly recommend it. Recommended using the 12-month median trailing free cash flow over the enterprise value to value the company. And I think those two work very well together in that we do want to look at their future cash flows and discount them to the present. And we also want to look at their past free cash flow over their enterprise value, which will account for their costs somewhat and determine that that's positive coming to the present. So in the past, we have the 12-month median free cash flow over the enterprise value to the current point of time. How are they looking now? Are they well financed? Are they heavily in debt? Do they have economical mind? Some of these other questions. And then how does it look going forward and discounting the future somewhat to the present? So hopefully you found this video entertaining, educational, and it can help you make a better investment decision going forward. I think I covered sometimes why we don't want to look at price to books, price to earnings, or some of these other momentum indicators that don't take into account whether the business is economically feasible, right? So this is Wobbly Giraffe. I hope you have a great rest of your day and rest of your week. June 6th was 2 days ago. So to all my vets out there, have a good one. Have a great one. That's a very important day for a lot of countries, including America. So that's awesome. I'm looking forward to a good rest of the week. This is D-Day +2, I guess. T2, T +2. So that's awesome. I guess they're probably off the beaches, but they're fighting close to the courtyard. The paratroopers are probably marching in town. So I love history. Anyhow, have a good rest of your day, good rest of your week. And until next time, thank you very much. Bye-bye. This is Wobbly Giraffe signing off.